Thanks for joining us for another episode of Balance Your Wealth. I'm your host, Ryan, and this week we're talking about one of the most misunderstood parts of a financial plan, insurance. We'll cut through the noise so you know what to keep, what to drop, and where you may need more coverage. Joining me today to help break it all down are Tyler, Nora, Adam, Bob, and Shaun. Tyler, you want to go ahead and get us kicked off with the term versus whole life insurance debate?
Yeah, I'll go ahead and start there. I'm a big term insurance fan. I think, the point of insurance is to cover, any outsized risk or catastrophic risk. And so when that comes up in conversations with clients, it's, hey, I'm getting married, need some insurance to, um, recover spouse's income if something were to happen. I need to pay off the home for the spouse if something were to happen. We're having kids, I need to make sure they're taken care of. So term is great. It is a great insurance product. It's probably what 95% of people out there should be using. Um, and get it early because it only gets more expensive as you grow older. So don't think, hey, is it too early for some life insurance? Go out, get some quotes for term, super cheap. On the other end of the spectrum, permanent life insurance, it has its place. You're not going to see as many use cases where it makes a lot of sense. One big one is estate planning, passing
Mhm.
assets to your heirs tax free. And that's where we use it a lot and sort of the more complex planning situation. So again, most of you out there listening, go grab some term insurance. If you have some unique scenarios, maybe take a look at some permanent life insurance.
Yeah, and Tyler, one thing to think about when you think about term, especially when we talk with young people, is they kind of default to what their employer offers. And sometimes that's usually one you got to consider, are you going to still be employed there? And secondly, is that enough for what you need? And sometimes it's kind of hard to plan for hypotheticals in the future, right? If you're a young person, you're not married, you don't have a mortgage, you don't have kids, does it make sense to buy it early to take advantage of that lower price? Or should you hold off until some of those life things happen? So it's all circumstantial, individual to other people, but those are all things you need to think about when you're thinking about when and how much do I buy for term life.
And ultimately, if you think you're talking to a financial advisor and their first piece of advice for a young person is you need to buy this whole life insurance policy, you are not talking to a financial advisor. Okay. You are talking to a salesperson. It's one of the reasons that I left the first firm I was with to start my own firm and be a part of Balance Wealth because you got to do things the right way. If they're not asking you if you have an emergency fund, if you're taking advantage of your company's 401k match, if you're maxing out your Roth IRA, before they start selling you a product, you need to run as fast as you can. And certainly there is, value in a whole life insurance policy. If you're a business owner, a farmer, you have a large asset that's not liquid, a whole life insurance policy is going to be the best way to mitigate taxes in the future. So it does have its place, but generally speaking, if someone's talking to you and the first thing they try to do is sell you a policy, you need to go out the door immediately.
Shaun, the other thing that I also love is for new parents, right? You just had a baby, maybe you're on your second, third, and all of a sudden in the mail, you get this Gerber life insurance for your child and all these taxes of you need to get it now. It's cheaper. It can turn into something, later in life for them. It's all a product, right? So if you're getting one of those, talk to your financial advisor. Don't go in and buy a life insurance policy for your, 1 week old, 1 year old, however that child is. Hopefully you have a plan in place and you have assets to cover if something catastrophic would happen. But be careful for that insurance, kind of sales technique.
Yeah, and a lot of times in the planning process, I view term insurance as a bridge to get us where, hey, we maybe don't need that much insurance. We've built this plan, now we're 65, 70 years old. We have enough assets, our debts are paid off. So the timing of insurance is a big thing too. You want it to cover where life is crazy, right? Your family's growing, maybe your incomes are growing and those things. But hey, insurance gets more expensive as we get older. So let's make a plan to make sure we maybe don't need it down the road.
Yep. And that's a great point just to wrap up here, Tyler, right? Like term insurance covers us while we're younger and have these a lot more unknowns. Permanent insurance or whole life insurance, I look at more like, hey, we want to pass something to the next generation. That becomes as you get older and you've got, kids, grandkids, whatever it may be. Permanent insurance comes in as a much more effective tool at that point. But when you're young, just like everybody else has said, that term insurance is going to be your best bet.
Awesome. And along with term insurance, another kind of product that people might use during their working years to protect against loss of income is disability insurance. Nora, you want to talk about that a little bit for us?
Yeah. So during our working years, income is extremely important when you're thinking about your financial plan and what you depend on. And disability insurance is something we certainly kind of cover. So a lot of times, again, similar to, term group life insurance policies, you can go to your employer. Typically, they'll offer short-term, long-term disability. But if you look outside of that, a couple of things we want to look at is one, what's your occupation? Right. If something was to
Hmm.
happen to you, let's say something happened to Shaun here and he, couldn't, work and sit at a computer, that's not super unlikely, right? But when we have clients that are maybe pilots or, um, you know, physicians, doctors, that if something was happening to their hands, they could no longer, do what they're trained to do. That's when supplemental disability insurance makes sense. But just know it's extremely expensive. So when we work with people, a lot of things go into that conversation. If you need disability other than outside of what your employer offers, occupation, extremely expensive. So depending on what you do, I normally would not recommend it for, everyday working from home, sitting at a computer type occupations.
Yeah, and one important consideration that comes with it too is, first of all, how much is going to be covered of your income if you're just utilizing the group insurance policy. It's often capped at a set dollar amount, maybe $5,000 or $10,000 a month. If you are a high earner, you're going to want to get additional coverage to help cover. And the other interesting piece to that is your group disability insurance, if it gets paid to you, is taxable income to you. Whereas if you go out and you get your own policy on the private market and you utilize those benefits, that is 100% tax free to you as a tax free benefit. So running the numbers, doing the math, and understanding, especially for those higher earners, how the net tax impact could impact you if you have some disability need is an extremely important step in the calculation here.
And I think one of the things that we always need to understand is insurance companies are really good at doing math. Okay. These actuaries, they could do some math. So the reason that disability insurance costs more than, say, life insurance is because there's a much higher probability that you're actually going to use it. So
Hmm.
oftentimes we'll see people are like, no, I don't have a disability insurance policy, but there's a reason it costs so much. And that's because there's a high likelihood that if you become sick, if you become disabled, that you're going to need to keep your income up. And if your family is relying solely on your income, it becomes even more important. So
Hmm.
ultimately, what we're doing is looking at what are the dynamics of your family, how much are each spouse working to contribute to the family income. We need to mitigate risk through an insurance policy so that your family's protected. And a disability insurance policy oftentimes makes sense because it's used so frequently among people in their lives.
One thing to be super aware of too is the qualifiers in those policies. Some people think, oh, I got a disability policy, it's going to cover everything. And you can get into some of those, and there's super complex details of what it will and won't cover. So just making
Hmm.
sure what's in your policy, what it covers before you sign on the dotted line.
Definitely. Moving on here, another kind of similar-ish product to disability is long-term care insurance. So, Bob, assuming Nick is not right and we don't all have Tesla robots to take care of us when we're old, maybe you can shed some light on what long-term care insurance is.
Yeah, long-term care insurance has, been a really interesting part of the insurance world here over the past few years. As folks keep getting older, we are living longer, we're being healthier in general. It's more and more likely that we're going to need some sort of long-term care, whether it's in our home or at a facility, whatever it may be. And it continues to get more expensive as well. And the big question with long-term care is, well, what if I don't need it? What if I pay into this insurance policy for however long and I never end up needing it? Two thoughts there. One is that's just about every insurance policy that we pay for, right? We pay for homeowners insurance, we pay for car insurance. We may pay into it for 20 years and never need it, but it's protecting us from a catastrophic risk that could come up with, in our lives. So, but the second thing is the long-term care or insurance industry has seen this problem, and they've developed a lot of different policy types to protect you in different ways, so that it can be that it has some death benefit associated with it, or it'll pay for long-term care, or you can get your money back if you put it into it after a certain period of time. So, long-term care is extremely important conversation. It should be part of an overarching plan to understand how much you actually need. But it's really, one that I think everybody, as they get into their 50s and 60s, should at least have a conversation around to see if you should have some and how much.
And the world's changed, right? This isn't the 70s and 80s where, families are having 5 to 7 kids. At least a couple of those rugrats still live close to mom and dad. People are going to college. They're not returning to their hometown. And so we don't have as many kids on average. There's a much higher probability that you're not going to have a child there to be able to help you. And so mitigating that risk through a long-term care policy may make sense for you and your family, depending on, familial history, where your kids are currently living, but at least having a conversation to make sure that there is a plan in place. And again, these insurance people are really good at math. The reason these things have gone up so much, kind of in price, is because insurance companies were losing their butt on their old policies because so many people were utilizing them that they said we have to
Mhm.
increase the cost because they're being used so much. So certainly worth a conversation with your advisor to make sure to see if it makes sense for you and your family.
Yeah, I'm seeing this firsthand. My wife's grandmothers, one lived to 94, one is 95 right now. And what
Mm,
I think is happening, to your point, Bob, is people are living longer. Their physical bodies, because our medicine is better, are making it, but the mental is where we're starting
mhm,
to see a lot of problems. So memory care units, that's not cheap. It's not cheap. And so, your body may make it to 94, 95, 100, but the mind starts to go, and there's not really a cure for that at this point. So I think that's where long-term care can really help, and I've seen that again play out with both of Sarah's grandmothers.
mm. Yeah, and that's the thing too, right? To Sean's point, right? There's not as many folks around to necessarily be there to care as mom or dad start to kind of decline. And Tyler, to your point, right? Like as our bodies, last longer just because of modern medicine, we need to find ways to mitigate that risk. And because the other option is either you have to go on Medicaid, which is a welfare program that is not something that you want to be on, or you have to have your kids start to fund it, right? And at that point, right, Tyler, to in your situation, right, like the kids might be in their 70s, right? And it's like, is that really fair? They're trying to retire and they're trying to do it. So, as we think about long-term care, it's not only protecting yourself and protecting your decisions there, but also in a way protecting your kids so that they don't have to bear the burden of responsibility on taking care of mom and dad if something were to happen to you.
Awesome. Switching gears here a little bit, Adam, a lot of the times our clients as they're retiring start to wonder, how do I bridge that gap between, maybe their working health insurance and if they're not ready for Medicare yet or whatever that situation may be. Maybe you can just talk about, how you think about that with clients and walk them through it.
Yeah, no, it's a great question, Ryan. I mean, if you guys are like me and it's health insurance, you're pushing it off to a true professional in that sector. However, health insurance is extremely important because it can devastate a plan or a path immediately, right? You may not always
Hmm.
need long-term or I'm sorry, long-term health care in the long run. It can be an option if it fits into your plan, but an accident in health insurance can mess up anybody quickly. And there's some
Hmm.
definite timelines that people need to be aware of as they're doing long-term planning, such as I need to be 65 years old to participate in Medicare, right? If I want to retire at 60, but I'm got 5 more years until I'm on Medicare, how do I bridge that gap? Am I overspending on or with Cobra up to 3 years? Am I naturally planning for it? It's absolutely an expense that people need to account for the older they get and the more they tie down their financial plan.
And we're seeing this more and more, right? The old system of, hey, I work till 65, I get a pension, and I die when I'm 70, is kind of gone, right? 401ks and IRAs were born. We see more and more young clients coming in and say, I want to plan to retire at 55. Well, we need to have a plan for that 10-year gap, as you talked about, Adam. How are we going to fund our health insurance from 55 to 65? And right now, the Affordable Care Act is out there, and it's an option. But it turns out it's not extremely affordable. And so when you start to look at those things, it may cost north of $30,000 for a couple per year to fund some of that insurance if they end up using the doctor a lot and have some of those big medical bills. So we've got to put a plan in place. We have to have a discussion, make sure that, yeah, it makes sense. I would love to retire at 60, but does that ruin my financial plan, as you mentioned, Adam, to get to 65? Or have I set aside enough that I'm going to be okay? And utilizing things like HSAs to be able to come up with some of that shortfall can be a great strategy.
Yeah, I think some second order effects of what you're saying, Shaun, is the non-qualified account is becoming a lot more popular. Hey, I want to retire early. I want to be flexible. Where can I pull money from? It's no longer let's pack everything into retirement and now I got to wait till 59 and a half to take it out. So, I'm seeing more and more people are like, hey, let's go the non-qualified route. I, value the flexibility over any sort of, maybe possible tax benefits of the other account. So, I think you're seeing that again because retirement age is starting to get earlier and earlier.
Well, and Tyler, to go off of that too, another important consideration is if you need to go, say, on the Affordable Care Act, currently, at least, there are premium credits depending on your income levels. And if you're able to pull from a brokerage account as opposed to having take from an IRA, you could potentially keep your income at a level where your health insurance premiums can actually be affordable or very low. Not only is the brokerage account very flexible in the access and ability to use it. It's also very tax flexible that can help in this specific situation in getting to 65 so that you get Medicare coverage, but you get that ACA benefit, as low as possible on the premium.
Yeah. And one of the things that if you're listening to this podcast and you're like, I got my time horizon before I even need to think about Medicare or retiring is 20, 30 years down the road. One of the things that I think we've talked about before is underutilized is an HSA. So if you can start contributing to that and you're like, I'm healthy, I really don't have medical expenses, start thinking about maybe those 20, 30 years down the road that you can utilize an account like that.
Yep. And fund it, but don't use it to pay for expenses, right? So fund it, put it in there. And again, I know we're talking about health insurance, but HSAs, like it ties together because all of these things fit together in a good long-term plan. And thinking about, 10, 15, 20, 30 years down the road is always a good thing to do.
Awesome. It's a great transition to the last segment here. So you might be thinking to yourself, this all sounds great, but how much insurance do I really need? So Shaun, maybe you can just talk through how you think about this with clients. How much insurance do you actually need in place?
Yeah, like all good financial advisors, I'm going to say it depends. And ultimately, right, it depends on what your family situation is. It needs to be customized to your life, your family's goals, history, and plan. I think if I was going to give just kind of a rule of thumb advice, though, we want to make sure that maybe we pay off any outstanding liabilities, houses, cars. So if I have a $500,000 mortgage, I need at least 500,000. And then if I have, 3 kids, then maybe I need $100,000 for each kid. That will pay for education, maybe another $50,000 for the wedding. So now I'm, in the $850,000 range. And then let's say I'm making $100,000 a year. I want to provide my spouse some type of income that they'll be missing out on based on my no longer being able to contribute from working. So let's say that's another 5 years. Maybe there's another, 500,000 there. I might go shopping for somewhere in the $1 to $1.5 million range for an amount of life insurance. And obviously this is customized between, what your family dynamic is and kind of what makes sense for you. But kind of a good rule of thumb is making sure that you got at least 5 years of income. You're able to pay off any outstanding liabilities, and then $100,000 to $150,000 per child. That way, my spouse doesn't have to worry about their education, their weddings, their first car, all those things. So again, the goal of insurance is to mitigate risk. I want to mitigate the risk of me, passing away and becoming a burden on my family rather than, hey, mom and dad took care of me and we're going to be just fine. throughout life, even though they're not present
Well,
anymore.
and the other important piece there, Shaun, that I just always like to touch on because it gets overlooked just from experience is, oftentimes one spouse works, the other spouse doesn't, or one spouse has, a higher paying job and one has a lower paying job. And often, especially for the non-working spouse, we're like, no, they don't need life insurance because we don't need to replace their income. Well, how much does it cost to take care of the kids? How much does it cost to take care of the dogs or the house or whatever it is, right, at home? So make sure that you're not discounting the amount of time, effort, and money that goes into being the stay-at-home spouse, whether that's the husband or the wife, right? And get a proper amount of life insurance on both in the couple, not just on the one who is working.
Yeah, you stole my point, Bob. That's a great point. I have as much life insurance on my wife as I do on myself because, it is definitely worth that. I don't know what I would do if something were to happen to her to replace
Mhm.
everything she does. So great point.
Yep. And then just tying in all the other insurances we talked about, right? We went through long-term care, disability insurance, health insurance, life insurance. Ideally, you have as much of those as you could possibly need for any circumstance that comes up. But in reality, we have to balance what we spend our money on and where the money goes, right? We can't just have it going out to each one. So that goes back to Shaun's point, understanding the values that you have as an individual, as a family, health history, resources that you have available, family setups, all of these things get factored into how much insurance should I have for long-term care or disability or life insurance. And really, it's hard to give a solid number without going through and bringing all those things together. So hopefully, as you make the decisions, you're not making them in a vacuum. You're making them within the context of your overall situation plan.
Awesome. Great conversation, everyone. Going to hand it to Bob as the winner of this week. Just kind of tied it all together for us and put a nice, pretty little bow on it. So we're going to let him rant about something he's got on his mind here for the next 30 to 60 seconds. So
Yeah,
go ahead,
thank
Bob.
you. Glad to get a victory. Feel like it's been a while, but it's baseball season. My son loves baseball. I love baseball, but the thing I don't love about baseball is how commercialized it's gotten, and especially with the bats. Like it's unbelievable to me. I remember growing up, my mom had a like a burlap sack that she'd bring to the baseball games. She'd dump it out. There'd be two bats in there that everybody could use, and there'd be, some helmets, and everybody just go, we'd play baseball. Now, every single kid has two or three bats. There's different rules and regulations. They're two, three, four, $500 a bat. We have $10,000 sitting in the dugout in baseball bats, and my kid's watching a strike three go by right down the middle. So like it's just wild to me what has happened to youth sports overall, but specifically right now with it being baseball season, the bats. It's just like that is the most wasted cost that I can see out there. So that's my rant.
Awesome. Glad that I'm not in the bat purchasing era of
Yeah, I
my
need some
life. So
insurance to cover the bats. So
awesome. So bat insurance, someone go ahead and launch that product if it doesn't already exist. It probably does though. So thanks for joining us for another week of Balance Your Wealth, and we look forward to seeing you next time.